The German election gave the markets a bit of a surprise, but are there any more other surprises on the horizon this week? Joining us today is Senior Market Analyst Halley from OANDA Asia Pacific. The German election proved to be a tighter race than expected, and although Angela Merkel's party did come out on top, the alt-right Alternative for Deutschland party got much more support than anticipated and actually came in as the third party. Now, what do you think this means going forward?
Angela Merkel still can form a ruling coalition, and we will still continue to see a stable government in Germany, albeit with a different makeup of seats in the parliament now. Probably for the first time now, Germans are expressing their anti-immigration sentiment for the first time since World War II. But nevertheless, there will be a stable government here in Germany, and thus, as far as the effects on the euro and the Bund market go, I do feel that they will be very short-lived. I think actually the real story here will be the trajectory of any potential tapering from the ECB, and that is going to have a lot more effect on Bund yields, which may start creeping higher into Q4, and also on the euro, which should be supportive for the euro continuing to go forward. So the sell-off in the euro, I feel, is very transitory, and we will see the uptrend resume sooner rather than later.
On Thursday, we have the final reading for US GDP. What are you expecting from this?
The US GDP, we are still expecting to see come in around the 3.1%. That should be still an excellent number that will keep the Fed interested in a December rate hike. So we are expecting another rate hike in addition to the start of this quantitative tightening in December. And we still believe that they're on track for at least 2 more next year as well. 3% is a fantastic figure. Maybe there will be some distortions in it from the hurricanes in the south of the United States. But we feel that'll be only transitory, and in fact that may add to the GDP and make up for any losses in the short term further down the track as reconstruction starts. Global interest rates are really the theme at the moment, with rising rates in the US, potentially rising rates in Europe. And so we feel that the US dollar strength will be mixed. So we will continue to see strength against the yen, some emerging market currencies, but not so much against sterling, for instance, or the Aussie, or the euro.
And lastly, we have the UK final reading for GDP as well. Do you think the data will come in line with the 0.3% quarter-on-quarter forecast?
Yeah, as far as the UK goes, the actual data coming out of the UK hasn't been so bad of late, given that we have all this Brexit doom and gloom. I think the 0.3 Q-on-Q is quite a reasonable number. You'll notice today that although Britain's credit rating was downgraded over the weekend, sterling's hardly reacted to that. I think it opened up 20 pips lower on the Asian Open very early this morning. I do feel that now that the Bank of England has blinked on the interest rate front, and that they feel now that the next move has to be higher, and despite Mr. Carney's efforts to mollify the tightening bias in the press, that sterling will now remain well supported. I can't really see sterling moving below the 134 level in the short term, and given that it's held 135, I suspect that the great sterling squeeze will continue. It's clear that even though the Brexit negotiations seem quite murky, that again, that the overall big trend that is really driving these markets at the moment is the gradual withdrawal of liquidity and the tightening of policies by various central banks around the world.
Well, that's all from us today, but we have plenty more broadcasts coming your way, so be sure to keep clicking back.